start recording. So this week, I know you guys are working on chapter 4. I just wanted to throw a couple things out there about chapter 4. And when you're doing this type of work in general, which is accounting for retail type businesses, or I think they call them, I forget what term the book uses, but in essence, selling stuff to people, right? So this is one of those areas where it's actually harder to do in a textbook setting than it is in real life. Because in a textbook setting, you have to differentiate when you read the problem. Am I the buyer of these goods or am I the seller of these goods? That's the first big differentiation you have to make, because you have to just pick that up from the context clues. Am I a purchaser or am I a seller in this given transaction? Because in real life, most businesses are both, right? They buy things from suppliers and then they sell those things to customers. And so if you remember nothing else, remember step 1 with this type of work is to understand where you are in the transaction. Am I a purchaser or am I a seller? Because if you're going to have different things going on, I mean, obviously, but again, in real life, there's no doubt about that. Like, I know exactly when I'm purchasing and when I'm selling, but in a textbook scenario, that's one challenge. So, and then the second challenge is to know whether I'm in a perpetual system or a periodic system. Let me share my screen real quick. Again, if you work for a business that, that does perpetual system-based accounting, then you would know that, and your business would always do perpetual accounting. And if you're in a business that used a periodic system, you would know that. Instead, usually they'll just tell you in a problem, this company uses a periodic system. Well, not usually, it has to kind of tell you that. But again, it's just another context, or if not context, a key term I have to look for when I'm reading the problem. Most companies now use perpetual inventory systems, meaning after every transaction, whether it be a purchase transaction or a sale transaction, I record that and update my accounting records, meaning whenever I make a purchase, I'm going to add to my inventory. And whenever I make a sale, I'm going to take it away from my inventory or reduce my inventory. That used to be a lot harder to do before the advent of point of sale systems, where we can, have a barcode, and just when we buy something from our supplier, we can type in the quantity. I've got 48 of these, and then scan the barcode, and it just adds it into our system. And then each time I sell it to a customer, I scan one and it takes it out. Before that, most businesses used periodic systems, which means they wouldn't keep track of their inventory as they went. Instead, they would just, they would keep track of how much they purchased throughout the year. And then at the end of the year, they would just calculate their cost of goods sold by saying, well, I had this much at the beginning of the year, and I purchased this much during the year, and I'd add what I had to what I purchased, which would tell me how much I had available. And then I would subtract out how much I had still at the end of the year, and that would tell me how much I sold during the year. And then I would have the number at the end of the year to be my starting for the next year. So fewer and fewer businesses use a periodic system. When I was a kid, I used to have to do inventory at my mom's store, which, really consisted of having a spiral bound notebook and like counting the cans of corn, 12, cans of peas, 6. It was awesome. Little did I know that nowadays I would still be thinking about such things, but of course on usually a grander scale. So those are the big things you need to know up front, because they're going to direct how you move forward in the problem. Am I the buyer or the seller, or the purchaser or the seller? And am I dealing with a perpetual system where I'm going to have to update inventory, or am I dealing with a periodic system where I won't update inventory, instead I'll record it as purchases and sales? So there's just a really brief overview. I guess I would be interested in answering any questions, or both general type questions or more specific, like we could look at specific problems.
I have a general question.
Okay.
I'm just having a hard time wrapping my brain around. So when I was reading about when you can get a discount, like if something is damaged, and then how you put, I'm sorry, I forget exactly what the term is for that. But I'm having a hard time like fully comprehending like the adjustment to the merchandise inventory. Like if they give you like that $50 discount, you're still adjusting your merchandise because you have the same amount of merchandise. Is it because the value is worth less? That's why, or maybe you could explain that a little bit more.
Sure. Yeah, so the idea is if your brain is like my brain, you tend to think of inventory as like a physical good sitting on a shelf. And
Right.
so I think, oh, well, if it was defective, I'm going to remove that from inventory. Or maybe I would sell it to somebody and let them know, hey, it's defective, and sell it to them at a discount or something if it wasn't fully defective, right? I mean, who knows? But remember that the number that's on our balance sheet and in our trial balance for merchandise inventory, that asset represents the cost of our inventory. So when I credit the merchandise inventory account, I may or may not be actually removing merchandise from my inventory. I'm just reducing the cost associated with that by, and this, like the one I have up on the screen, is $30. And so that's why you would go ahead, even on an allowance, even if I kept the merchandise, I would still credit my merchandise inventory account to show that, because the seller is giving me $30 back, that merchandise cost me $30 less than I had originally recorded.
Okay, but if I had a discount and the discount would apply after this was subtracted from it. So like if I could get like a 2% discount or whatever, it's not from the total, it's from the total minus this, and then you subtract that.
Right.
Is that right?
Right, because you can see here, I haven't paid for it yet, right? So when they offer me this allowance, or sometimes even more than an allowance, it'll be a return or something, I'm going to subtract that amount off, and because accounts payable represents the amount I owe to my supplier. Okay. And so I now owe $30 less to my supplier than what I owed before. So they're not going to give me, a discount off of money that they've refunded me, so to speak.
Right. Okay.
Does that help?
Yes.
Okay,
Yeah,
good.
it does.
Because sometimes I just explain stuff and it didn't make it any clearer. This is
No, it does. It
like,
helps. I'm thinking in, yeah, dollars, not quantity of items.
right. Because that's totally how I make all of this work in my brain, is I like legitimately, especially when we get into the whole like first in, first out and last in, first out stuff, to make it work in my brain, I just have to like picture stuff on a shelf. And I'm like, if it's, you know, and then first in, first out would be like the oldest stuff is the first stuff I'm selling. And so then when I have that all squared away, then I get confused by this, because why did I reduce my inventory? I didn't actually reduce any of it. So it's the cost. So, okay, other questions? That was kind of specific. It was quite specific, but it wasn't a specific problem. Other questions that arose?
Can I ask about the closing balances?
Sure.
Like, um, so I think I'm trying to compare it too much to like other closing balances. Like, but it's different, but it is the same. When we're closing out the credit balances on the temporary accounts that are there. And I think it's throwing me off because I think when it's asking me for it, it's also trying to trip me up on what is a temporary and what is a permanent account at the
Hmm.
same time. So I have like this list and they maybe don't all apply, like so like it's asking to like close out credit balances and then debit balances on the temporary accounts. and then the income summary and the dividends. And I feel like the dividends is the only one that's like kind of the same, but the other, because it's separating it like credit balances, is it asking for the list of all the ones that had credit balances and then a list of all the ones that had debit, or is it really just like one?
Yeah, okay. So we only close our temporary accounts ever. Okay, so permanent accounts don't get closed out. And
Right.
so the permanent accounts are the assets, the liabilities, and the stockholder equity accounts. So that means we only close out revenue, expenses, and dividends. So the only accounts that would have credit balances that are temporary in nature are revenue accounts. And the only accounts that would have debit balances that are temporary in nature are expenses and dividends. And so I don't know why they decided to use a different terminology and say the credit balances accounts. That would just be another way of saying the revenue accounts, because those will have a credit balance at the end of the financial period, and the expenses will have a debit balance at the end of the financial period.
Okay.
And so really, and the only thing that's different when we're dealing with a merchandising or like a retail or a wholesaling company is they have a new expense that we haven't dealt with before called cost of goods sold, but it's still an
Mhm.
expense. It'll have a debit
But yeah,
balance.
it's still an expense, right?
Mhm.
So that would still be a temporary debit.
Uh-huh. It'll have a
Okay.
debit balance, and then we're going to credit it to take it back to zero. And then it has a new asset, but we don't close assets, in inventory. We didn't have that inventory asset with the things we were working with before. Um, and the name of the revenue account will be different. Instead of service revenue, it'll be sales or sales revenue or merchandise sales or something like that.
Okay. So for this problem that I'm looking at, it has sales returns and allowances.
Mhm.
Does that fall under expenses?
So,
Or is it just being subtracted from your sales?
right. Yeah, so it's actually like a contra revenue account. And what I mean by that is it's
Mm.
part of your sales revenue account, but it has a normal balance on the debit side rather than the credit side, because it's any of those. It acts like an expense. Does that make sense? But really,
So when I'm
it's
working
an
through this problem,
unrevenue.
would I list it as one of those then, as one of the debit ones and not?
Yeah, because you're going to have to, if it has a balance, it'll be on the debit side. So to close it, you're going to have to credit it. So maybe
Still have
that's why they're using that terminology.
okay.
Do you want to look at the problem specifically? And
Yeah, can I share my screen maybe, because now
yeah,
I'm complicating it. Okay.
just a second. Let me make it so you
Yeah.
can. All right, you should be able to share your screen now.
Okay, share screen.
Let's see, everything that they're showing on here.
It
Oops,
disables my microphone when I screen share.
oh, that's weird.
Let me try it again. I was like, wait, you can't hear me, but it says your microphone's disabled. So let me try that again.
Okay.
If I just say entire screen, maybe that'll be better. Okay, you can still hear me now.
Yep, I can hear you.
Great. Okay, so when I look at this and I look at like the credit balances on the temporary accounts, to me that's like sales.
Right,
And then I know like this last one that's dividends, like that dividends is going to be its own thing.
right.
But here, when I look at the debit balances on temporary accounts and the income summary account, that's where I'm starting to get confused now, because this wouldn't necessarily be all of these, because do some of these actually fall under the income summary?
No. So we close revenue to income summary. So so like go back to number one.
Okay, so when I do number one and I close that to income
Right.
summary.
So you're gonna debit
So I'm gonna
sales.
debit my sales, not sales discounts, just my sales. which is that 541,000.
right,
That's going to go to income summary.
right.
So then that's what's going to apply here.
Right. Well, so then when you go to number 2 and you close all those debit account balances, you're gonna credit all of those accounts, right? So you're gonna debit income summary. So that'd be your
Income
first
summary
entry, actually.
first. Yeah.
Right,
And then, but that'll be the total of all of these.
right. And then
Okay.
your income summary account will have some balance, right? Because now you've credited it 541,000. You're gonna debit it all these other things. And then it'll have some balance that you'll have to close out to retained earnings.
Okay. And the cost of goods sold. So that's the tricky one. That is actually an expense.
Right. The reason it's separated is because it's a special expense. It's what's called a variable expense. The more you sell, the higher the expense, as opposed to a fixed expense like your rent or insurance, which doesn't track with your sales.
Right.
I mean, there's probably other reasons, but to me, that's the most obvious one.
Okay. So if I add all that together, okay, I think that is. So then that's what I have that. So then when
You
I
need to,
close the income summary.
yeah, you'll need to figure out the balance of income summary, which will be 541,000 minus 454.4. I think it's a little blurry on my end, but
Because I am, so it's 86,600, but that's where I am then. This is, I'm crediting income summary at this point.
well, so income summary will have a credit balance, right? Because it was credited 541,000 and it was debited whatever that big amount was. So it, right, so it will
454.
have a credit balance. So to close it, you'll have to debit it. Does that make
So
sense?
yeah, so I debit the income summary
Right.
here, that amount, which is
Hmm.
the difference of the two.
Right.
Okay.
Which if you think about it is your net income, right? It's your revenue minus your expenses. And we could say your net revenue minus your expenses, which is your revenue minus returns and allowances minus discounts. So your net revenue less all of the expenses.
Right. Okay. That makes sense. Okay.
And that'll close to retained earnings would be
Retained earnings. Yeah. So that's where I get that. And then that is where the dividends then come into play, because the dividends that's a debit of the 36,000. And that also goes to retained earnings, right?
yeah, except that your dividends has a debit balance. So you actually,
Oh, I could do it other way around.
yep.
I can tell you where I went wrong on my test right now. Okay. Then this goes to dividends.
Right.
That's
You figure
how that.
since retained earnings is an equity account, then
Oh,
when
that's wrong.
what, is something wrong?
Yeah, I put in
Oh,
only 3,600.
yeah, since retained earnings is an equity account, then when we debit it, we're reducing retained earnings. So closing the dividends will reduce our retained earnings. And then the net income there will increase our retained earnings.
Right. Okay. I think that all makes sense.
Oh,
Thank you.
green.
Oh, green is my favorite color. I miss it on a test. I'm not gonna lie.
Sarah
Uh,
Rose, did you have any questions? I don't want to steal the
Yeah, I
time
don't want
all
to
from you.
monopolize it. Yeah.
No,
That's
I haven't even had a chance to look at it. I'm in my car.
okay.
So I just get on these to make sure that I absorb as much as I possibly can, because the way that you put it is a lot easier than what the book does.
Okay.
And that was the last question I had. So
Okay.
that
Well,
was really, really helpful.
super cool. Let me see if there's any. So you guys feel comfortable with, let me show a couple more things on my screen here real quick, just to make sure you're good with that. And I know you can't look at it, Sarah Rose. Don't try to look. Um, with,
I'm not driving. I'm sitting
oh,
right now.
okay.
I'm taking my kids to church activities. So
Okay. Tuesday night church activities. Well,
yeah, we share
that's
our building, and so we
that's
swap every year.
that's where you go wrong. All right.
Yeah, I know.
Ours are Tuesday nights too. I feel ya.
So we share a building, but it's just like we have 3 wards in our building, and it's like on the first Wednesday of the month, this ward owns the building, and you guys will have to do your thing somewhere else. And like,
Ooh.
and then on the second, and a lot of times if you just say like, hey, is anybody using the cultural hall? They're not anyway, right? So,
Yeah.
all right. So anyway, we're comfortable with this nomenclature, I guess, the purchase discount. You got that, Annalisa? You feel comfortable with that?
Yeah, I feel good about that. But that's something I utilize at work. So
Okay.
that one I feel pretty comfortable with.
And the most common you'll see in real life, at least that I see, are either like a 110, so 1% discount in 10 days, or a 210. Sometimes I'll see like a 215, but the most common I see is like an NEOM, which means net end of month, which just means you owe the whole amount by the end of the month. And that, those are the most common ones I see. Oh, hey, we have a preacher that preaches outside my building, and he's starting up. One day he called me out by name as I was walking out and told me that getting married in the temple wasn't going to save me, and he,
Real sad.
I like, thanks, bro. But I thought, do I go talk to him? He doesn't seem in talking mode. He seems more like he's like in hardcore mode right now. Maybe I'll try to talk to him when he chills out. And then so the multiple step income statement is the other thing that's different in this chapter from what we've seen already, which is the idea that, we have our sales minus any sales discounts and sales returns gives us our net sales. And then our net sales minus our cost of goods sold gives us our gross profit. Sometimes you'll see gross profit listed as profit before fixed expenses or something like that. And then you separate expenses, operating expenses, into selling expenses and administrative expenses. So it's really the same thing as income statements we've dealt with before. It just is more detailed, broken down into some sections. And then there's often this other revenues and expenses section. This is for like revenues and expenses that are from non-operating situations. For example, my business is a storage business, and so my primary source of revenue is rental revenue from renting storage units to people. Occasionally, we'll auction things, and so we might call that auctioning, and other gain, the money we make from the auction or something like that. We don't actually do it that way, but that might be an example of how you do it. I think, or like a business is selling off some assets, like here at the college, maybe we have old computers or something. And so we're replacing them with new computers and then just auctioning off the old ones. Any revenue we make from doing that is not our normal operating revenue, which at the college is the revenue we bring in from tuition, but instead it's an other revenue. And the same with other expenses. Those would be like non-regular expenses, some exceptional item. Anyway, so that's a multi-step income statement. And then a classified balance sheet, which I just have the current asset section here, but it breaks down our assets into current assets and long-term assets. And they're in order of what's called liquidity, which means I think the best way to describe liquidity is cashiness, how easily convertible to cash an asset is. So cash is the most liquid of all assets because it's already cash. Accounts receivable and merchandise inventory, those are both assets that we have full intention of turning to cash, right? We collect accounts receivable from customers, inventory is there to be sold. And then there's stuff like office supplies and store supplies, which we're not ever going to convert to cash, but we're going to consume or use up in the near term. So typically, if an asset is cash or will be converted to cash or consumed within the next year, we call it a current asset. And assets that are longer in nature, longer life in nature, like vehicles and equipment, those are listed as long-term assets. Sometimes they're listed as property, plant, and equipment, which is another name for long-term assets. And sometimes you'll even see them called non-current. That's what's confusing is you learn all this stuff in school and then you go to a job somewhere and they use slightly different terms and you have to figure out their terms. And the same thing with liabilities. We'll have current liabilities. Those are debts that are due within the next year, and long-term or non-current liabilities. Those are debts due more than a year out. So you'll see that additional detail on a classified balance sheet. All right, that was quite a spiel, I know. Sorry, that's my mother's word, spiel. I think it's Yiddish, but I don't know. Anyway, other questions or are we good?
Real quick, can I just clarify a couple things on the assignments?
Sure.
The concept videos, even though it has points on it, it actually is not worth any points that go towards your grade. Is that right?
Correct.
Okay. And then if you're not a homework presenter, we can just ignore that. And then that, as that week comes around, then it just kind of gets removed on the grading scale, right?
Correct. So
Okay.
you as a presenter, you have 2 presentations, and those are the only things that count for a grade. And the rest of them, what happens is I have to go in and tell the system only look at the people who are assigned here. And so it'll blank you out after I grade the other people's because you're not assigned.
Okay.
Yeah, I don't know what your view looks like in the syllabus. When you look at the syllabus, does it show how your assignments are weighted like this over on the side?
Yes.
So you'll see concept videos have a weight of 0, which means that the score is multiplied by 0, and so it's not worth anything. It's unfortunate that we can't just make those scores on them go away, but it's something to do with McGraw-Hill interfacing with Canvas. I have the same thing with courses I teach here at Eastern Arizona College, and I put like a little green check mark next to all the ones that are required for your grade to try to make it clearer. Like you only have to do the ones with green check marks by them or whatever, but it's still a little confusing.
Yeah. Okay. Well, thank you. That clears it up for me then.
Okay, terrific. All right. Well, any volunteers for a prayer? We have a lady in a car and a lady, I guess, in her office or something, but whoever wants to say the prayer, that would be great.
I could hand the phone to one of my boys and they could do it.
Okay, yeah, make one of your kids say the prayer. That's
There
perfect.
you go.
Yeah.
Yeah.
Okay.
Blessings.
All right. Here's Porter.
Of course, me. Dear Heavenly Father, thank you for this day. Thank you for my mom taking this class. Thank you for everything that you have provided all of us. Please bless that we can all live safe for the rest of this week. In the name of Jesus Christ, amen.
Amen. Excellent, Porter.
Amen.
Thank you.
Thanks, Porter.
All right. Thank you so much, Brother Cox.
Great. Have a great night, everyone.
All right.
You too.
Bye-bye.
Take care.
Bye.